Greetings. Today is Wednesday, October 2nd, 2024, and this is our monthly market monologue. But before we dive into any stock market data, many of you know that Paul recently got married, and he's now living on the western side of the state, actually in the Asheville area. So some of you have already reached out checking in on Paul. We certainly appreciate that. Paul and his family, thankfully, are fine. They have been displaced, so they're living with a friend of theirs in Charlotte for right now. But he's able to work, and we're just going to keep on keeping on. So thank you for praying for Paul and for his family and for everybody that's been affected. That said, let's go ahead and dive in. So on the screen right now is our seasonality chart. This is showing the average monthly performance in the S&P 500 dating back to 1950. So you can very easily see that September historically is the worst month in the calendar year. However, September 2024 was very good. So if we look at it on a monthly candle chart, you can see this is September right here. So what we typically see in a bull market is you typically see weakness at the beginning of the month and you see strength at the end. Same thing on a daily basis. In a bull market on a daily basis, you might see weakness at the beginning of the day, but at the end, we have a strong close. You see strength at the end. That is certainly what we saw in September. September started pretty rough. The first couple of days we were trading down, and you can see how low the market went, but the market rallied. The S&P 500 rallied pretty nicely into the end of the month. So that is a sign of strength. Now, it's October 2nd. We're seeing some weakness yesterday and again today so far. Obviously, what's happening in the Middle East, what's happening with the longshoreman strike, those are not helping things. But typically, we see weakness at the beginning of the month, and you see strength at the end. So if you want to go back and you want to look at the average or how September has done since 2019, there I've highlighted September, and you can see that in 2019 it was positive, but 20, 21, 22, 23, all negative months. This year, very positive, and that tends to bode well for the rest of the year. Now we have the S&P 600. So this is another way that we're going to look at the seasonality, but this is the smaller companies. So the S&P 600 is a small cap index. Again, you see September is historically very negative, but September 2024 was very positive. Now we have the NASDAQ. Again, highlighting the various Septembers since 2019, but 2024, September, a very positive month. And again, the seasonality chart for NASDAQ, again, historically a very negative month, but so far this year, it's the best month for the NASDAQ. So moving on to the advanced decline line, we now have that on the screen. The S&P 500 is in the top pane. The advanced decline line, which is calculated this way, is in the bottom pane. Again, one of the things that we look at this for is we're looking for divergences. We don't want to see the S&P 500 advancing while the advanced decline line is declining. That's a warning sign. Well, how did September end? September ended at all-time highs on the advanced decline line. That is a very good sign. Now, if we flip the screen and we take a look at the Russell 3000, as you know, that is one of the ways that we measure the broader market because it's got 3,000 stocks. S&P 500 is only got 500, and it's just the large caps. So the Russell 3000 is much broader. How did that end? Not as strong. The Russell 3000 has a little bit of work to do, but I'll add some references so you can see. Russell 3000 ended at the highs, so that is a very strong close. However, the advanced decline line wasn't able to quite make that same peak. So a little bit of work to do in the Russell 3000, but generally speaking, I like what I see here. Now, moving on and taking a look at, we've got mega caps on the screen. That's a positive 5%, 5.4% for the month of September. But look at the next best performer. It's actually small caps. Small caps is VB is a Vanguard small cap ETF that we like to look at. And VB had a very strong month as well. So it's very good news that the small caps had such a strong month. So adding the bonds into the mix, you can see long-term bonds did end the month positive, but this is that same index. This is TLT right here, and you can see that it struggled into the month's end. The reality is bonds have had a nice strong rally these last several months. So to some extent, they need to have some period of digestion, and that's continuing today, by the way. But overall, the trend has definitely shifted back into a little bit of a positive trend for bonds, helping the more conservative portfolios, or at least the more traditionally conservative portfolios. So the last thing that we'll talk about today is the presidential election year. As we've already discussed, October, November, December, and January are the 4 best months in the stock market year. That is still true in presidential election years as well. Obviously, between now and the election, we can certainly see some volatility, but generally speaking, this is still the best time in the stock market year. The only 2 times that really stand out as far as presidential election years are concerned is 2000 and 2008. So let's take a look at those 2 years in particular to see if we see any evidence that suggests that we might have reason to be concerned this time around. And again, we're going to look at the advanced decline line. So top pane, again, S&P 500. Bottom pane is the advanced decline line. And again, here's 2007. So this is 2008 going into this election year. So you can see there was a negative trend happening from the last quarter of 2008. But look at the entire year. The entire year was a negative year. In particular, I want to highlight why we use this advanced decline line the way that we do. This is not a be-all, end-all indicator, but it is a pretty big warning sign when you see the indexing advancing, but the advanced decline line is going down. So that's 2008. That's not similar to what we're seeing now, as we've already demonstrated. But let's take a look at the year 2000. And you can see the last quarter of that presidential election year, you're in a negative trend. But you're in a negative trend pretty much the entire year. But in particular, take a look at the advanced decline line and that massive divergence. From 1999, the S&P 500, for the most part, continued to advance. But more and more stocks were declining. There's a very big divergence in the advanced decline line back in at the turn of the century. We don't see that happening right now. Ultimately, what I'm seeing underneath the surface, it looks pretty encouraging. So stay tuned. We're not making predictions by any stretch of the imagination. As you know by now, the markets can turn very, very quickly, and that's why we do things the way that we do things. We want to be able to seek shelter if we think shelter is necessary, because in today's environment, things move awfully, awfully fast. So again, if you have any questions, by all means, feel free to reach out to me. Happy to see if we can be of service to you and your family in managing your nest egg. Thanks for watching, and we'll talk to you next time.